This week, it really feels like everything is happening all at once. We've got huge news in tech, we've got some high-stakes political drama, and a massive breakthrough in global trade. And somehow, all of these different threads are leading to one single critical moment, the Federal Reserve's big decision on interest rates.
Okay, so let's just dive right into the central puzzle of the week for anyone with money in the market. Because honestly, it's a real head-scratcher when you look at the signals coming from Wall Street versus what everyone expects to happen in Washington.
And this right here, this is the core contradiction we have to unpack. On the surface, things look amazing. The market is acting like the economy is absolutely firing on all cylinders, which makes the Fed's next move seem, well, kind of weird.
Just look at this number. That's the S&P 500, a key benchmark for the whole stock market, and it's been smashing records. That is a classic sign of a booming economy. It's exactly the kind of environment where you'd expect the Fed to be thinking about raising rates, right? Not cutting them?
And this slide just lays it out perfectly. On one side, you have the market basically screaming that everything is strong. On the other, the Fed is about to use a tool, a rate cut, that you normally save for a weak economy that needs a boost. So what gives? Well, to find the answer, we got to look way beyond the stock ticker.
To really get the full picture here, we have to zoom out and look at the global pressures that are weighing on the Fed's decision. And there was no bigger story on that front this week than the whole saga of TikTok, which looks like it's finally reached a conclusion.
Now, this is way more than just a corporate buyout. It's a huge signal about U.S.-China trade relations. For months, all the uncertainty around TikTok was a pretty good stand-in for the broader trade tensions. Getting this resolved takes a major piece of global risk off the board, and that gives the Fed a much clearer picture to work with.
And believe me, the stakes could not have been higher. According to Treasury Secretary Scott Bessent, the administration was totally prepared to just ban the app in the U.S. if a deal didn't get done. This agreement was literally struck just before that deadline, avoiding a huge disruption and maybe, just maybe, signaling a bit of a thaw in those trade hostilities. So how'd they pull it off? Well, a brand new group of U.S. investors, including some real heavyweights like Oracle and Silver Lake, are going to take a controlling stake in TikTok's U.S. business. This whole setup is designed to solve the national security worries that started this whole thing, while, of course, keeping the platform online for its millions of American users.
Okay, so that's the global side of things, but the Fed isn't just watching what's happening overseas. It's also navigating some really intense political pressure and a very divided economic picture right here at home.
Now, for months, the White House has been very publicly calling for the FOMC, that's the Federal Open Market Committee, the group that actually votes on this stuff, to cut rates, and to cut them aggressively. This adds a layer of political pressure that is highly unusual for the central bank, which is supposed to be independent.
And this isn't just background noise anymore. That pressure now has a voice inside the room. The Senate just put Stephen Muron on the Fed's Board of Governors, and he is widely expected to argue for an even bigger rate cut, putting him in line with the White House's position.
And this really gets to the heart of the Fed's dilemma. While they're facing all this pressure to stimulate the economy, you look at the tech sector and it seems to need anything but stimulus. The AI boom is in full swing. Google's Gemini just leapfrogged ChatGPT to become the #1 free app. Microsoft is dropping $30 billion on AI infrastructure in the UK. It is a tale of two economies for sure.
But for every signal we see of a red-hot tech sector, there's another data point that's flashing yellow. And the Fed is paying very close attention to a cooling job market. Recent numbers from both the US and the UK are showing a slowdown in hiring. And for the Fed, which has a dual mandate to keep prices stable and employment high, a softening labor market is a really powerful reason to cut rates.
So all this high-level economic chess, why does any of it actually matter to you? Let's bring this down from the Fed's boardroom and talk about how it hits you right at home, because these decisions have a very real impact on your wallet.
So get this, if you've owned a home since 2005, you're likely sitting on an absolute gold mine of wealth. A house that was bought back then for around $229,000 is now worth more than $435,000. That is a 90% jump. That's a huge amount of home equity. And here is where the Fed's actions really hit home. Because the market expects the Fed to cut rates, mortgage rates have already fallen to a 3-year low. So, for all those homeowners sitting on that pile of equity, these lower rates create a massive opportunity to refinance and maybe take out a home equity loan at a much lower cost.
Which brings us right back to the main event, the Federal Reserve's meeting. With all these conflicting signals, a roaring stock market, a cooling job market, political pressure, global trade deals, What are they actually going to do?
Well, here's the funny thing. The actual decision to cut rates, that's not the real story here. The market has already decided it's a done deal. Traders are pricing in a more than 96% chance of a 25 basis point cut. That's just a fancy way of saying a quarter of a percentage point. So the headline news is pretty much already baked in. The real suspense, the thing every single investor on the planet will be watching for, is this, the dot plot. Now, it sounds super technical, I know, but it's just a chart. It shows where each Fed official thinks interest rates should be in the future. It is the single best clue we have about the Fed's real intentions.
That dot plot is going to tell us everything. Is this week's cut just a one-and-done kind of thing? Or is it the start of a whole series of cuts? When you're caught between a tech boom, a slow job market, and all this political pressure, this one chart is the most important clue we're going to get about where the economy is really headed.
Ultimately, the Fed is walking a tightrope here. It has to balance the risk of an overheating tech sector against a slowing job market, all while navigating politics and global uncertainty. Its next move won't just affect Wall Street, it's going to send ripples through the entire economy and right into your wallet.